Welcome back. You're watching Business Lunch on CNBC-TV18. Well, Utpal Sheth, the CEO of Rare Enterprises, visited the CNBC-TV18 studios over the midweek, trading holiday to participate in the town hall with Jefferies global strategist Chris Wood. My colleague Mangalam caught up with Utpal and spoke to him about the market fundamentals and his expectations from the upcoming budget. Listen in.
See, there are pockets of overexcitement in the markets, and there could be corrections. But as Rakeshji used to say, the mother of all bull markets is ahead of us. And I believe that we are in the midst of a structural and secular bull market, notwithstanding the corrections.
So from your lens, where is it that you see pockets of exuberance? And in a market which is so exuberant, as you pointed out, where are the pockets of value, according to you?
See, rather than talking about specific sectors or segments of the market, and while there is over-exuberance in some pockets, as I said, the fundamental point is that risk, economic and financial risks, have actually diminished. Okay. If you look at the interest rate differential between India and the US, if you look at inflation differentials between India and the US, if you look at the forward rupee depreciation rates, if you look at the volatility of Indian exchange rates, or if you look at the volatility of Indian interest rates, or if you look at the strength of the banking system or corporate sector leverage, all of these factors denote a significantly lower risk than in the past. And this lower risk is being translated into higher multiples. Now, the question is, will these higher multiples have a new risk? Right. That is possible. A new risk is possible. But the traditional economic and financial risks to valuations have diminished.
Difficult to typically quantify that new form of risk. But in what form or shape do you see that new risk emerging? How do you see the genesis of risk emerging?
Risk is usually something that comes out of the left field.
Yes.
So, but it could possibly be change in the taxation paradigm for equities. It could be the supply side response of equity issuances and so on. I mean, both these are possible risk factors, but I'm sure that risk is going to come from an unexpected, whenever it comes, it will come from an unexpected source.
Because I ask you this because we're standing ahead of this big imponderable, the union budget. So just wanted to know if any of those risks are something that the street is assigning any sort of weight to, the risks that you just spoke about, tinkering with the taxation policy, maybe something to do with supply.
I think these risks are there in the consciousness, maybe not on the action agenda for most players, but I think the bigger challenge for the government is to take this opportunity of a strong fiscal position, of a strong current account position, and give a boost to the structural growth rate of the economy.
What, according to you, would be a good budget, and what are your expectations here?
I think continuity of policies itself will be a good budget, and that is what I would expect.
And barring the taxation issues that you spoke about, what is it that could topple the apple cart?
I can't think of any.
Right.
I'm not thinking of toppling of the apple cart.
All right. Speaking sector specific, we've seen a big rally in a lot of these PSUs, defense names, rail names, etc. as well. Do you think the kind of rally that we've seen, just by virtue of the price move, is there some sort of exuberance out there?
See, there is always a lead lag between price and performance.
Yes.
And maybe some of that is playing out in these segments that you are mentioning. But the structural story seems to be in place.
All right, market has picked up momentum and overall buying seen, but it's a wrap on this edition of Business Lunch. But remember, our Market Town Hall special with Chris Wood comes up next, so stay tuned for that. Thanks so much.